At the age of 22, you're probably at the point where you're done with college and just entering full-time employment or have already entered the workforce full-time. If I could rewind the clock and be 22 again, I'd tell myself one thing: start investing now. There's no better time to begin building your financial future than when you're young. The earlier that you start, the more powerful that your results will be, thanks to the magic of compounding, consistency, and smart decision making. I'm Stephen Gage, owner of Vision Commercial Development. In this video, I'm going to share exactly what I would do if I were 22 again, starting from the basics of investing to more advanced strategies. Whether you're stepping into adulthood or looking for ways to improve your financial situation, this roadmap can help you achieve financial independence. When you're young, time is your biggest advantage. The earlier that you start investing, the more time you have to let compound interest work its magic. Compounding is the process of earning returns on both your original investment and the gains that it generates. Over decades, this effect can turn even small contributions into substantial wealth. The one thing I tell my kids the most is to sacrifice lifestyle while you're young and put away as much of your paycheck as you possibly can into investment accounts. It pays off by giving you a life of freedom when you're ready to retire. Let me give you an example. If you start investing just $50 a month at age 22 with an average annual return of 8%, by the time you're 65, you could have over $180,000. Now, if you wait until you're 31 to start and invest the same $50 a month, you'd only have $80,000. That's the power of time. It's much more important than the amount that you invest. But if you did this same investing with $500 a month, you'd have over $2 million when you go to retire at age 67. Starting early gives you the ability to take calculated risks. At 22, you have decades to recover from market downturns, allowing you to focus on growth-oriented investments. Don't let the fear of starting small hold you back. It's all about getting started, and the earlier you do that, the better off you're going to be. One of the biggest mistakes new investors make is putting all their money into one type of investment or stock. The key to long-term success is diversification. Diversifying your investments means spreading your money across different asset classes, stocks, bonds, and real estate, even emerging opportunities like ETFs or REITs. This reduces your overall risk and protects you if one sector underperforms. But it's not just about where you invest, it's about how often. Being consistent is crucial. Automate your contributions to investment accounts so that you don't have to think about it. Whether it's $50 a month or $500 a month, regular investing ensures that you're consistently building your portfolio and takes the stress out of market timing. Remember, it's not about timing the market, it's about time in the market. If I could go back, one of the first things I'd do is put my money into low-cost index funds and ETFs. These are some of the simplest and most effective investment tools for beginners. Index funds and ETFs track the performance of a specific market index, like the S&P 500 or the total stock market, giving you exposure to hundreds of companies with a single investment. Why are they so great? First, they have incredibly low fees, which means more of your money stays invested and grows over time. Second, they're diversified by nature, spreading your risk across multiple companies. Third, they're simple. You don't need to be an expert to invest in them. And finally, ETFs are highly flexible. You can buy and sell them throughout the day, just like stocks. If you're unsure of where to start, look for funds that track the S&P 500. Historically, the S&P 500 has delivered strong returns over the long term, making it a solid choice for building wealth. If I were 22 again, I'd take full advantage of retirement accounts like 401ks or Roth IRAs. If your employer offers a 401k plan, especially one with a company match, this is the easiest way to start building your retirement savings. That company match is free money. It's like getting a 100% return on your contribution up to a certain amount. For those investing independently, a Roth IRA is an incredible option. With a Roth IRA, you contribute after-tax dollars, but your investments grow tax-free, and withdrawals in retirement are tax-free as well. It's a powerful way to lock in tax-free income for your future. Plus, Roth IRAs offer a wider range of investment options compared to most 401k plans. Starting these accounts early allows you to take full advantage of compound growth, setting you up for a comfortable retirement. Before diving too deep into investing, one of the first things that I do is build an emergency fund. Life happens, cars break down, medical bills arise, unexpected expenses can throw you off track. An emergency fund acts as a financial safety net, ensuring that you don't have to rely on high-interest credit cards or dip into your investment accounts during tough times. Aim to save 3 to 6 months worth of living expenses in a high-yield savings account. This will give you peace of mind and the confidence to invest more aggressively, knowing that you'd have a cushion for the unexpected. At 22, real estate might seem out of reach, but it's not as unattainable as it seems. One of the easiest ways to get started is through real estate investment trusts, or REITs. These allow you to invest in real estate without owning property, providing steady income and long-term appreciation. For those ready to take a bigger step, house hacking is also an excellent strategy. This involves buying a multi-unit property, living in one of the units, and renting out the others. This rental income can cover your mortgage and even generate cash flow, all the while building equity in the property. Real estate is a powerful wealth-building tool, and starting young gives you the chance to take full advantage of its potential. If I could tell my younger self one final piece of advice, it would be this: never stop learning. The more you know about personal finance, investing strategies, and market trends, the better decisions that you'll make. Read books, watch videos, and surround yourself with financially savvy people. But don't let the need for knowledge paralyze you. Start with what you know. Take action and learn as you go. The earlier you start, the more time you give yourself to succeed. If I were 22 again, I'd embrace the power of compound interest, invest consistently in index funds and ETFs, take full advantage of retirement accounts, and explore opportunities in real estate. I'd build an emergency fund for financial security and always keep learning to stay ahead. The most important step is to get started, even if it's with small amounts. Over time, those small actions add up to something incredible. So what's stopping you? Start today. Let me know in the comments what steps you're taking to build your financial future. And don't forget to like, subscribe, and hit that notification bell for more videos on investing and building wealth. Thank you guys for watching, and I'll see you in the next one.